Hi friends, let us discuss in this part about the cash flow statement. Cash flow statement is important in the sense that it helps us to understand how much money the company is making and how much it is spending in any accounting period. It is broken into three parts. One, cash flow from operating activities, cash flow from investing activities, cash flow from financing activities. These three together form part of the total cash flow in any organization. It has two methods, one direct method and two indirect method. In indirect method, net income from the profit and loss account is taken as the base to which non-cash expenses like depreciation are added and non-cash incomes are deducted, and net adjustments between current assets and current liabilities are taken to arrive at the cash flow from operating activities. In the direct method, cash spent and cash received alone is taken to produce the cash flow statement. Non-cash expenses like depreciation are ignored. In the indirect method, the cash flow statement is not said to be very accurate as adjustments are required to be made. The cash flow statement under direct method is accurate as no adjustments are made here. The direct method only needs segregation of cash transactions from the non-cash transactions. But the indirect method of cash flow statement is easy to prepare and most companies prefer this method. Cash flow from financing activities refer to the inflow and outflow of cash from the financing activities, like changes in capital from the issue of securities like equity shares, preference shares, issue of debentures, and redemption of securities or repayment of a long-term debt or short-term debt, payment of dividend or interest on securities, etc. Normally, the items include cash dividend paid, increases in short-term borrowings, decrease in short-term borrowings, long-term borrowings, repayment of long-term borrowings, sale of shares, repurchase of shares. Cash flow from investment activities include proceeds from disposal of property, plant and equipment, cash receipts from disposal of debt instruments of other business entities, receipts from sale of equity instruments of other business entities, sale of long-term assets and other investments, payments for acquisition of property, plant and equipment, payments for purchase of debt instruments of other business entities, payments for purchase of equity instruments of other business entities, purchasing long-term assets and other investments. Cash flow statement is also related to some important ratios, the following ratios, namely operating cash flow ratio. Operating cash flow ratio is equal to cash flow from operating activities by current liabilities. If the operating cash flow ratio of a business entity is less than 1, the entity is not generating enough money to pay off its short-term debt. Cash flow margin ratio. Cash flow from operating activities divided by net sales gives the cash flow margin ratio. The larger the percentage of margin, the better for the business entity. Current ratio tells us if the current assets are sufficient enough to meet the company's current debt. The formula is current ratio is equal to current assets by current liabilities. This ratio indicates how many times a company can meet its short-term debt, and it is a measure of firm's liquidity. Quick ratio is equal to current assets minus inventory by current liabilities. The quick ratio, if it is less than 1, the company has to sell inventory to meet the short-term debt. This is not considered to be a good position for the firm to be in if the ratio is less than 1. Let us see the solution here. Let's see the illustration here. Spicy Restaurants Limited balance sheet as of 31st March 2022 is given here, along with the profit and loss for the year ended 31st March 22. From the above illustration, we have to prepare cash flow statement under two methods, one indirect method and to direct method. In the indirect method, the depreciation is added to net profit before tax, and in the direct method, depreciation is ignored. So when the plant equipment has been sold, depreciation has been adjusted to find the gain from sale of plant in the indirect method, and whereas depreciation is ignored in the direct cash flow method. The rule to remember while preparing cash flow statement is that number 1, any increase in the assets in the current year over last year result in a decrease in cash flow. That has to be deducted. Any increase in the assets in the current year over last year result in a decrease in cash flow. A decrease in the assets in the current year over last year result in an increase in cash flow. Point number 3. Any increase in liabilities in the current year over last year result in an increase in cash flow. Any decrease in liabilities in the current year over last year result in a decrease in cash flow. Now we have to take the balance as per profit and loss account, profit before tax, and then add depreciation for the indirect method, and any interest income which is there has to be deducted to find the net income from the operations. Then we need to do working capital adjustments regarding the current assets increase or decrease and current liabilities increase or decrease to arrive at the cash flow from operating activities. In that process, we also deduct income tax paid. Then we go to cash flow from investment activities. Investment activities cover sale of plant and equipment during the current year, purchase of plant and equipment during the year, and sale of securities, short-term securities, or purchase of short-term securities. All that will come in the investment activities. The financing activities will cover the finance charges, interest paid, short-term borrowings, long-term borrowings, and these things are covered under the financing activities. Cash flow from operations is thus arrived at after adjusting for working capital changes, and cash flow from investment activities and cash flow from finance activities are together aggregated to find out the net cash flow from the business operations. This is adjusted with the cash and cash equivalents at the beginning of the year and the closing balance of cash and cash equivalents as per the balance sheet should tally. This is the cash flow statement. The importance of cash flow statement is that we can study the liquidity of the concern with various ratios like operating cash flow ratio, cash flow margin ratio, current ratio, and quick ratio, as we have already explained. Kindly go through the illustration and you will make the best of the cash flow statement and how to prepare it. Thank you very much.